Welcome everyone to Financial Fridays. Woohoo! I am your host, Octavia Conner, and I am super excited to be here with you today. So today we're going to discuss the balance sheet, right? So to become a profitable consultant, you must have the skills to read, understand, and use financial statements to your advantage. Now, the balance sheet helps consultants understand the financial position of the company on any given date. So, today I will explain the balance sheet so that you are equipped to use it as a decision-making tool in your firm. Now, I am Octavia Conner, CEO of Say Yes to Profits. I am the consultant's virtual CFO. I help consultants scale to 7 figures and beat the IRS tax game with my signature Say Yes to Profits system. We are streaming live right now on multiple platforms, but no matter where you are joining us from, if you have any questions or any comments, you can leave them in the section where the questions and comments go, and I will answer them at the end, okay? Also, make sure that you share this on your social media outlet, no matter where you're joining us from. Now, as I mentioned, today we are going to discuss the balance sheet. So I want you to pay close attention or make sure that you come back and watch this several times because this is highly important. Now, here's the thing. The balance sheet is the most misunderstood but critical financial statement for consultants and entrepreneurs. Now, the balance sheet provides a snapshot of the company's financial strength. Most entrepreneurs and consultants really only focus on the profit and loss statement. However, you cannot have a healthy business if you do not have a healthy balance sheet, period. Okay? Hear me clearly. Now, the balance sheet is a snapshot report that enables you to identify the trends in your business's finances and if the company is stable enough to expand. All you have to do is look at the balance sheet to get this information. In addition to that, your ability to reduce risk and maximize returns lies within the lines of the balance sheet. Okay, so what I'm going to do right now is share my screen so that we can deep dive into the balance sheet. Okay, so let me share my monitor. All right, so what we are looking at here is the 3 components of the balance sheet. So I'm going to go step by step so that you have a clear understanding of this, okay? So first and foremost, the 3 components of the balance sheet are the assets, liabilities, and equity, all right? The assets are on the left side of the balance sheet as what you see here. And the liabilities and equities are on the right side of the balance sheet. And we're going to go into this a little bit more later, okay? The first thing that I want to discuss, however, are the assets, right? Now, the assets are resources that the business owns. The assets are listed based on their liquidity, meaning they are listed based on how easy the assets are at converting them into cash, okay? So I created this simple and balance sheet for you all to really get the understanding of this so that when you're looking at your balance sheet, you're perfectly clear. Right? So when you're looking on the asset side of the balance sheet, you will have your current assets listed first, which ideally make up the bank accounts and accounts receivables as you see here. Okay. Now, accounts receivables are the money that your clients owe you. So basically, you have issued invoices in most cases, but your clients have yet to process the payments. That will be listed here under accounts receivables. Let me know in the comments if you all are with me so far, okay? Then you have other current assets, which are items the company owns that, again, can be converted into cash within one business cycle. One business cycle is generally within 1 year, all right? Now, under other current assets, oops, you guys, sorry, I went to the next page. But under other current assets, you have inventory and prepaid expenses. Now, inventory are goods that are available to sell. Now, here's the thing. An excess of inventory is like having money on the floor. Now, I need you to pick that money up and put it in the bank account, meaning sell your inventory. Now, under inventory, you also have prepaid expenses, and prepaid expenses are the value of expenses that you have paid in advance, such as rent and insurance. Okay? Then we move on to long-term assets, and a part of long-term assets are your fixed assets. And long-term assets are the items the company expects to use, replace, or convert into cash beyond one business cycle. In most cases, beyond 1 year. Fixed assets are the tangible assets such as property, plant, equipment, and machinery. All right. Then you have intangible assets. And intangible assets are non-physical assets such as goodwill, trademarks, and intellectual properties. Now, for most consultants, you will not see intangible assets on the balance sheet unless they are purchased. Okay? Let me know if you all are with me so far. Now, when you add your current assets and your non-current assets, you arrive down here to your total assets. Again, the assets form the left side of the balance sheet, which must equal the right side of the balance sheet, the liabilities and the equity. Okay? Yes, you all are good so far? You're with me? Hi, Herbert. Thank you so much for joining. So let me know if you have any questions or comments, okay? So now we're going to move to the liabilities, right? Now, your liabilities are monies that your company owes. It is the debt owed by your company to others, okay? Current liabilities are those that are due usually within 1 year, and they're normally listed based on their due date. And then you have long-term liabilities, those things that are due beyond 1 year or beyond a business cycle. Now, some examples of liabilities are accounts payables. These are the amounts owed to your company's vendors or suppliers. You also have credit cards, payroll liabilities, and short-term and long-term liabilities, okay? So that's what you see here. You see accounts payable. You see that this fictitious company has an Amazon credit card with a balance on it. It has other long-term and other short-term liabilities, okay? Most consultants incur many of their liabilities by purchasing items on credit to fund the business operations. And we're going to talk more about that in just a second. Now, when you add your current liabilities and your long-term liabilities, you arrive to your total liabilities. Okay? So let's move on to equity. Now, equity on the balance sheet is the amount of money available after all liabilities have been paid. It is the ownership interest in the company. Now, a consultant's equity represents retained earnings and funds contributed by its owners or shareholders. All right. So let's talk about the components that make up the equity. So as you see here, you have open balance equity. And open balance equity is the account used to offset the opening of new accounts. Then you have retained earnings. Now, this account is used to track all profits from previous years minus any losses or dividends. Here's the thing about retained earnings. You should avoid using this account unless you are writing off items from the previous years or you have received adjusting journal entries from the previous years. Now, adjusting journal entries are normally provided to you by your accountant or your CPA. All right. So be very, very careful about retained earnings. Last, you have net income. Net income is carried over from your profit and loss statement. Okay. So that is your equity. When you add those up, you will arrive to your total equity. And when you add up your liabilities and your equity, you will arrive to your total liabilities and your total equity. Okay? Now, again, this make up the three components of the balance sheet. Assets on the left side, liabilities and equity on the right side. You all are with me so far? Let me know if you have any questions. Even if you're watching the replay, if you have any questions or comments, leave them below. All right? So moving right along. Now, once you have your balance sheet, you actually have an important balance sheet formula. So let's get into that, right? So your accounting equation is your assets equals your liabilities plus your equity. And again, your assets, your current assets, your non-current assets, is the resources that your company owns, okay? Your liabilities is any debt, any financing that you have, and your equity is the owner's financing, the owner's interest in the company. This is your accounting equation, or you may even hear it called the balance sheet formula, all right? So now I want to touch on how to use the balance sheet and why it's so important to have a healthy balance sheet for your business, okay? So let's get into that part. Now, if the company's liabilities exceeds its assets, the company is operating upside down. This is not the position that the company wants to be in. That means that the company is really honestly not healthy or teetering on being extremely not healthy. That also means that the company is operating off of its credit cards and loans. All right. The goal of a company in this unfortunate position would be to increase revenue, maintain a positive cash flow at all times, generate a profit, and reduce debt. Okay? You want your company to be cash flow positive and profitable always. But if you're constantly operating off of your credit cards and your loans, this is basically money that you're using from others to fund the operations of your company, meaning your company really cannot stand on its own. Now, a company in this position needs a solid financial plan and accountability that will enable the company to save and use the revenue that is earning strategically. All right. I cannot stress this enough. So make sure that you're paying close attention to your balance sheet. And another thing that I want to point out when you're looking at your balance sheet is that your total assets here should equal your total liabilities and equity. So you see how for this example, your total assets down here of $36,578.49 equals the same amount for your total liabilities and equity when you add them up. Assets on the left, liabilities and equity on the right. Now, when you're looking at QuickBooks Online or some other accounting softwares, you're going to see this in a long format, right? And that's just for the purpose of you to view it. But your balance sheet is made up a left and right side. And the left side should equal the makeup of the right side. And again, if your liabilities are higher than your assets, you're operating upside down. So going back to our example, the liabilities for this example is $24,283.52. The assets are $36,578.49. So in this case, the liabilities are not more than the assets. All right. Let me know if you all have any questions, and I'm going to summarize this for you so that you are crystal clear on your balance sheet. Okay. So the balance sheet is used to determine if the business has enough working capital to sustain its operations. This is why the balance sheet is so important. The balance sheet also enables you to determine what the company is worth. It is a great reality check when you look at your balance sheet. The balance sheet is a reality check because it helps you determine if the company is financially sound and stable. I cannot stress that enough. Now, the balance sheet is used internally and externally. Internally, it is used as a decision-making tool. Externally, it is used to report the business's financial status to lenders, investors, and other stakeholders or shareholders. All right. So here's the thing. You want to diligently track your company's finances. And 29% of small businesses fail due to a lack of cash flow. When you're looking at your balance sheet consistently, you will spot a lack of cash flow before it even occurs. You will understand the financial health of your business. The balance sheet will help you determine the risk, the returns. The balance sheet will help you secure loans, capital. The balance sheet will help you identify health ratios of the business and even more. All right. And here's the thing. I'm going to leave you with this. If your liabilities are exceeding your assets, as I just explained, you do not want to go and increase your liabilities even more by having another credit card or another loan on your business. Again, that is operating upside down. And I want you to operate right side up, meaning you have more cash in your business than you have loans in your business. Okay. Now, to help you with this, of course, I have to give you additional resources. So if you have yet to download the Say Yes to Profits plan, you want to go to sayyesToProfits.com/plan and download this plan to help you get to a financially stable position in your company. Okay. So make sure you go to sayyesToProfits.com/plan. All right. Now, if you have any questions or comments, definitely leave those below. Thank you all so much for joining me today. If you're watching a replay, leave your questions or comments below as well, and I will come back and I will answer them, okay? So this is Octavia Conner, the consultant's virtual CFO. Make sure that you share this on your social media outlets. If you're joining us on YouTube, click the subscribe button right now. Subscribe, and I can't say it enough, subscribe, okay? Until next time, everyone, say yes to profits. Toodles.